Imagine a country so rich, so advanced, that in the 1980s the world believed it would soon own the future. Tokyo's real estate was worth more than all the land in the United States combined. Japanese companies were buying American icons, from movie studios to skyscrapers. The Japanese miracle, they called it. But then, the miracle stopped. 3 decades later, that same country still hasn't fully recovered. This is not just Japan's story. It's a warning to every modern economy, because the same forces that trapped Japan are now spreading across the world. Before we begin, tell me in the comments, where are you watching this video from? Now, let's uncover how Japan's greatest success became its longest economic nightmare. To understand Japan's 30-year trap, you have to understand its rise. After World War II, Japan was devastated. Its cities bombed, industries destroyed, and economies shattered. But in just a few decades, it became an economic superpower. Between the 1950s and 1980s, Japan's GDP grew at an average of 9% per year. By 1988, Japan's stock market accounted for 45% of global market capitalization, almost half of the world's total wealth. Companies like Sony, Toyota, Panasonic, and Mitsubishi became global legends. Economists began to wonder if Japan had discovered a new model of capitalism, one that could outcompete the West entirely. But the seeds of disaster were already planted, because behind the miracle was a fragile illusion built on cheap credit, speculation, and political denial. By the mid-1980s, Japan was flooded with money. After the 1985 Plaza Accord, the US and its allies agreed to weaken the dollar to reduce America's trade deficit. That made the Japanese yen stronger, and exports, Japan's economic engine, suddenly became more expensive. To cushion the shock, Japan's central bank, the Bank of Japan, BOJ, slashed interest rates. Credit became nearly free. Corporations borrowed heavily, consumers took on loans, and investors poured their savings into real estate and stocks. Property prices skyrocketed. In 1989, a single square meter of land in Tokyo's Ginza district was selling for $300,000, enough to buy a luxury car. The total value of land in Japan was estimated at 4 times the entire United States. Stock prices followed. The Nikkei index rose from 13,000 in 1985 to nearly $39,000 by the end of 1989. People truly believed Japan's wealth would never end, but bubbles always burst, and Japan's was about to implode. In late 1989, the Bank of Japan made a critical decision. It began raising interest rates to cool speculation. The result was instant and brutal. Stock markets crashed. By 1992, the Nikkei had fallen more than 60%. Property prices collapsed, wiping out trillions in household wealth. Corporations that had borrowed heavily were now trapped. Their assets were worthless, but their debts remained. Banks stopped lending. Consumers stopped spending. And what followed wasn't a typical recession. It was stagnation. An entire nation froze economically, unable to grow or move forward. Economists call it the lost decade. But as years passed, it became clear it wasn't one lost decade. It was 3. Here's what makes Japan's crisis unique. Unlike most countries, Japan never faced mass unemployment, food shortages, or total collapse. Instead, it experienced something subtler, a liquidity trap. The central bank cut interest rates to nearly zero. In theory, that should have encouraged borrowing and investment. But it didn't, because businesses didn't want to borrow. They were already drowning in debt from the bubble years. And consumers didn't want to spend. They feared prices and wages would fall further. No matter how much money the government pumped into the system, it just sat idle. Japan was stuck in a loop. Low spending, low growth, low confidence, even lower spending. By the late 1990s, Japan's GDP growth had collapsed to less than 1% per year. deflation, falling prices, became normal. And the miracle economy of the 1980s turned into a nation afraid of its own future. One of the biggest reasons Japan couldn't recover was its banking system. During the boom, banks had lent recklessly, assuming property values would always rise. After the crash, those loans turned toxic. But instead of writing them off, banks pretended they were fine. This policy became known as evergreening bjorn, rolling over bad loans so that companies didn't officially default. It made Japan's economy look stable on paper, but in reality, it was filled with zombie companies, businesses that couldn't die, but couldn't grow either. By 1997, Japan faced a full-blown banking crisis. Several major financial institutions collapsed, and the government had to inject over $500 billion in bailouts. Sound familiar? That ES because Japan's crisis predicted the Mamane 2008 global financial collapse. Decades before it happened, Japan's leaders couldn't accept that the miracle was over. Instead of restructuring debt or reforming industries, they kept printing money and building infrastructure. Highways, bridges, airports, many of them unnecessary, just to keep the economy busy. This became known as the Maya construction state. Meanwhile, government debt exploded. By 2000, Japan's debt-to-GDP ratio was 140%. By 2010, it was 200%. And today, in 2025, it's nearly 260%, the highest in the world. Yet despite that spending, Japan's economy barely grew. The country entered a strange twilight, rich, peaceful, technologically advanced, but stagnant. A society growing older, with fewer workers, less innovation, and declining hope. Behind the numbers was a social transformation. During the boom years, Japan's corporate culture promised lifetime jobs and rising wages. But after the crash, that system broke. Young people faced lower salaries, temporary contracts, and fewer opportunities. Many delayed marriage or stopped having children altogether. Japan's population peaked in 2010 and has been shrinking ever since. Today, 1 in every 3 Japanese citizens is over 65. Entire towns are emptying out. Schools are closing. The economy doesn't just face a financial trap. It faces a demographic one. In Part 2, we'll explore why Japan still can't escape this trap. How its deflationary spiral reshaped global economics, and why countries like the US, China, and Europe might be walking down the same path today. Because the story of Japan's fall isn't just history, it might be our future. Japan entered the 2000s like a boxer who had forgotten how to throw punches. The world had moved on. The internet was reshaping economies, China was rising, and Silicon Valley was minting millionaires overnight. But Japan? It was still fighting yesterday's battles, still printing money, still waiting for inflation that never came. By 2001, Japan's central bank, the Bank of Japan, BOJ, had slashed interest rates to 0%. They even pioneered something no one else had tried before, quantitative easing. In simple terms, they started buying massive amounts of government bonds to flood the economy with money. The world called it experimental, but Japan called it survival. And for a while it worked, or at least it looked like it did. The yen weakened, exports rose slightly, and the Nikkei stock index began to breathe again. But underneath, the sickness remained. Companies were still too cautious to invest, households still too scared to spend, and wages barely moved. The government's desperate gamble. Between 2000 and 2010, Japan's government spent trillions on public projects, roads, bridges, and new airports. Debt piled up, yet growth refused to return. By 2010, Japan's national debt had crossed 200% of its GDP, the highest in the developed world. Every new stimulus was like giving another sugar shot to a diabetic economy. It kept things alive, but never healthy. Then came the 2011 Fukushima disaster. An earthquake, a tsunami, and a nuclear meltdown all in one. It crushed the already weak economy, and forced Japan to shut down most of its nuclear power plants, which had supplied nearly a third of its electricity. The nation that once symbolized efficiency now faced rolling blackouts, energy imports, and rising costs. Still, the people adapted, because if there's one thing Japan has, it's resilience. The lost decades become a generation. By the time Shinzo Abe took office in 2012, Japan's lost decade had become two. Abe promised a bold revival plan, soon nicknamed Abenomics. It had three arrows: aggressive monetary easing, massive government spending, structural reforms. For a moment it seemed to work. The yen weakened, the stock market doubled, and inflation ticked up slightly. But then reality hit. The demographics were merciless. Japan's population was shrinking, fewer young workers, more retirees. By 2015, 1 in 4 Japanese citizens was over the age of 65. Today, it's nearly 30%, the oldest population on Earth. That means fewer consumers, fewer innovators, and more pressure on a pension system already drowning in debt. In short, Japan had run out of people before it ran out of ideas. The price of aging: walk through Tokyo today and you'll see it. Convenience stores with robots at the counter, nursing homes run by AI assistants, and entire rural towns abandoned. Japan didn't just age, it emptied. Fewer babies meant fewer workers, and fewer workers meant slower growth. The government tried everything: tax cuts, childcare incentives, even encouraging women and foreigners to join the workforce. But culture changes slower than policy. So Japan adapted in its own quiet way. Automation. Companies like Toyota, Panasonic, and Sony began investing in robotics and artificial intelligence, not for profit, but for survival. If people couldn't fill the jobs, machines would. The economic paradox. Here's the paradox of modern Japan. Despite decades of stagnation, its people are still among the richest, safest, and most technologically advanced in the world. Unemployment is below 3%, poverty is low, and infrastructure remains world-class. How? Because Japan replaced growth with stability. It chose calm over chaos, security over risk. But there's a cost. The younger generation now lives in an economy without ambition. Where once there were dreams of being global leaders, now there's quiet acceptance of being comfortable enough. In 2025, Japan's GDP growth hovers around 1%, debt has crossed 260% of GDP, and the yen has fallen to multi-decade lows. The BOJ still keeps interest rates near zero, still buying bonds, still chasing inflation like a ghost. And yet, the rest of the world is starting to look a lot like Japan. The world's Japanification. In Europe, interest rates have been near zero for years. In America, after COVID-19, the Federal Reserve also printed trillions to prop up markets. Even China is struggling with deflation and an aging population. What used to be called Japan's problem is now a global preview. The fear economists whisper about is called Japanification, a slow, beautiful decline. No crashes, no revolutions, just endless stagnation masked by comfort. And as the West repeats Japan's playbook, massive debt, cheap money, aging populations, the parallels are impossible to ignore. The lesson the world forgot. Japan's story isn't a failure. It's a warning. It shows what happens when a nation becomes too successful, too stable, and too cautious to take risks again. The economic miracle that rebuilt Japan after World War II was powered by ambition, sacrifice, and speed. But the trap that followed was built on fear. Fear of failure, fear of inflation, fear of change. Today, Japan stands as a mirror for every nation chasing prosperity without purpose. It reminds us that wealth without growth is comfort, and comfort without vision is decline. So the next time someone praises Japan's calm economy, remember this. Behind the politeness, the neon lights, and the efficiency lies a quiet truth. The miracle never really ended. It just slowed and kept waiting for a spark that never came. If you found this story eye-opening, let me know in the comments. Do you think the world is slowly becoming the next Japan? And tell me, where are you watching from? Your city might just be the next chapter in this global story.